You think insurance is a bet. You pay in and hope you never have to claim. But the company isn't really making money on that bet at all. The real profit is hidden in the gap between when you pay and when they pay. It has a name, and it made Warren Buffett a fortune. By the end of this, you'll understand why insurance companies are almost structurally guaranteed to win. And stay to the end, because the secret isn't in your premium or your payout. It's in what happens to your money in between. Here's how we all picture insurance. You pay a monthly premium. If disaster strikes, they pay out. If it doesn't, they keep your money. A simple wager, you're betting something goes wrong, they're betting it won't. And on that bet alone, insurers often barely break even or even lose money, big storms, big claims. So if the bet isn't where the fortune is made, where is it? The answer is in a single word most people have never heard: float. Think about the timing. Everybody pays their premiums, constantly, every month. But claims only get paid out sometimes, and often years later. So at any given moment, an insurer is sitting on a gigantic pile of money it has collected but not yet paid out. That pile is the float. And here's the magic. That money isn't just sitting there. The insurer invests it in stocks, bonds, whole companies, and keeps the returns. It's using your money and everyone else's to make more money in the gap before it ever has to hand any of it back. This is the part that turns insurance from a gamble into a machine. Because if they price the policies even reasonably well, that giant investment fund doesn't just come free. It comes better than free. Normally, to get a huge pool of money to invest, you'd borrow it and pay interest. But an insurer gets its pool from premiums. And if the premiums it takes in are a little more than the claims and costs it pays out, then it's not paying to hold your money. It's being paid to hold it. That's the insight Warren Buffett built an empire on. He called float money the company holds but doesn't own. And he used Berkshire's insurance float, which grew from a few $1 million into well over $100 billion, as a colossal, nearly free engine to buy stocks and businesses for decades. So the premium you pay isn't really the product to them. It's the deposit that fuels the fund. So change how you see the whole thing. When you buy insurance, you think you're buying protection against a bad day. And you are. But you're also doing something else. You're handing the company a free, permanent, ever-filling investment fund and letting them keep every dollar it earns. That's why insurers are so structurally hard to beat. They can lose the bet, pay out more in claims than they took in, and still come out ahead because the float they invested all year made more than the loss. The premium flows in today, the claim flows out years from now, and everything that happens to your money in between belongs to them. They don't need to win the wager. They own the time. So insurance isn't really a bet against disaster. It's one of the greatest money-holding businesses ever invented, dressed up as a safety net. You pay for peace of mind. They get a bank they never have to pay interest on. Now, to be fair, always win isn't literally true, and this isn't a scam. Badly run insurers absolutely go bankrupt. A single hurricane season, wildfire, or pandemic can blow a hole in them, and the float is money they genuinely owe, mishandle it, invest it recklessly, and it can destroy the company instead of enriching it. More importantly, insurance does something genuinely valuable. It pools everyone's risk so that when disaster doesn't wipe out your family or your business, that protection is real and worth paying for. The honest point isn't insurance is a ripoff. It's that its true profit engine is the float, your money in the meantime, not the simple premium minus payout that almost everyone thinks it is. So, insurance companies win because the money isn't in the bet, it's in the gap. You pay premiums now, they pay claims much later, and in between they invest your money and keep the returns. Price it right and that float is better than free, the exact engine Buffett used to build a fortune. The next time you pay a premium, remember, you're not just buying protection. You're making an interest-free deposit at a bank that only ever pays out if something goes wrong. Send this to whoever thinks insurance is just a monthly bill. And subscribe, because behind almost every boring industry is a hidden money machine exactly like this one. And there's a new one waiting for you right now.